special guest. I'm happy to introduce you to Monick Halm. So she's an educator and advocate for women to create passive income streams through real estate investing. Her mission is to assist 1 million women to achieve financial freedom through real estate investing. And for that, there is a website, raygoddess.com, Instagram, Ray Goddess, or Monick Halm, Facebook, LinkedIn. I mean, all these channels are going to be linked down below. So you have to make sure that you get in contact with Monick before or after the interview. But Monick, personally, I just want to say a big thank you for joining me today on this episode.
Thanks for having me, Martinez.
Thank you. Thank you. I appreciate it. Okay, so let's begin. Let's begin, and let's maybe explore personally. I mean, what place are you coming from, and how have you decided, when it comes to your personal journey, why have you decided to kind of pursue real estate investing?
That's a good question. I did not grow up wanting to be a real estate investor. I knew nothing about real estate investing. I have a very loving family. I'm a first generation American. My parents are from Haiti. And growing up, they always told me like to be successful, I had to be a doctor, lawyer, professor, engineer. Like that was you go to college, you go to graduate school,
Mhm.
you take one of those tax,
Rich dad, poor dad
tax and
story. Yeah,
yeah,
yeah.
the poor dad story, right? Is what I learned. And so of those, I became a lawyer. I chose law, and I was really miserable as a lawyer, but that's a whole other conversation for a different for a different episode. But what I did learn about real estate, or the only thing I'd been taught, was buy a house. That you should buy your own house. And I went to do that after I'd been practicing for a couple of years. And I live in Los Angeles, which is a very expensive market. And even though I had a six-figure income, a starter home in a semi-decent neighborhood is upwards of $600,000, $700,000. And I couldn't afford anything by myself. So a friend of mine who was in a similar boat suggested that we buy a duplex together. The original idea would be a property with two equal sides. He'd take one, I'd take the other. But instead, we ended up finding this old, beautiful craftsman that had a larger unit in the bottom level, a two-bedroom apartment upstairs. There was a converted garage. There was another one-bedroom apartment in the back. And we each took a bedroom in one unit. And then we rented out the upstairs. We rented out our back house. We even rented out our basement. And I started house hacking before I knew that was a thing. I was just like, this is awesome. These people are paying our mortgage. This is so great. And then when I met my husband, he had a duplex. We got a single family together. And then after the market crashed in 2008, we sold a duplex. We started flipping houses when houses were on sale until they became not so on sale. And so in 2015, I started getting really frustrated because it was hard. It was very competitive, hard to find properties in LA that made sense. And then flipping is really a job. It's very active. It's not passive income. And I wanted something more passive. So we started looking for fourplex, which was the largest thing I could imagine at the time, and nothing cash flowed. And, looking at $2 million plus property, no cash flow. It's ridiculous. So at that time, I ended up meeting this man who would become my mentor and totally changed the trajectory of my investing. I met through a mutual friend, Robert Helms, who's the host of the Real Estate Guys radio podcast. Our mutual friend knew I was really frustrated with what was happening with real estate, with the flipping and trying to find this fourplex. And he said, you should meet my friend Robert. He's going to be in LA tomorrow night. And so I went to meet him. And in 10 minutes, he gave me a couple huge paradigm shifts that completely changed the trajectory of my life. And one thing, so he was asking me what I was doing. I told him about the flipping and how hard that was and looking for this fourplex and nothing cash flowed. First thing he told me was, LA is a tough market. I always say, live where you want to live, invest where the numbers make sense. And I went, oh, because until you said that, I always thought you had to invest where you could drive to your property,
Yeah.
touch it, self manage it. It just didn't occur to me that I could invest outside of where I live. So literally, that opened up the world to me. And the next thing he said was, and you can buy that fourplex by yourself, but you're limited to your own capital and credit. He said, alternatively, you could buy a 100, or you could bring a group of investors together and buy 100, 200 unit apartment building. He started telling me about the benefits of that. And I was like, mind blown. Like, that's a thing? I literally thought that was only for billionaires. I had no idea that regular people could do that. But I was like, that's what I want to do. I want to learn how to do that. And went home, told my husband that night, there's this thing, it's called syndication. You bring groups of investors together. Let's learn how to do this. And we bought tickets. So the real estate guys teach how to do syndication, and they were having a seminar January 2016 in Phoenix. So we bought tickets that night. And that next January, we were there. And in that year, 2016, we went from the beginning of the year, we had 2 doors. And at the end of the year, we had over 1,000 by doing syndication and bringing groups of investors together. It was pretty phenomenal. And that's the path I've been on since.
That's beautiful. That's a very great story. And again, shout out to Robert. You know, you didn't mention the last name, but again, to kind of
Robert Helms.
There you go.
Yeah.
So he kind of widen your kind of, view, and, kind of gave you those mind shifts, which was the crucial point in your personal business and personal journey, which is really great. So can you talk about those 1,000 doors? I mean, what part of them are you as an LP, GP? Like, what states are those deals in? Can you go through those?
Yeah, I'll talk about them.
Yeah.
We only still own one of all of the deals that we did. We've since sold and exited. But so the first thing we did was we were part of the GP. So we syndicated a mobile home park in North Carolina. That was 109 units. And then we, or 109 lots. Then we passively invested in a couple of deals. One was 318 units in Dallas, another 514 units in Atlanta. And then we syndicated 2 apartment buildings in Albuquerque, New Mexico. Well, one was like townhouses and apartments, so 51 unit townhouse community, and then 77 unit apartments complex. And so those 128 units, they were pretty close together. So we were managing them as one, even though we did 2 separate syndications for each, 2 separate owners. We bought them a week apart, but from 2 different sellers. And so between all that got us over 1,000, and we closed on the last one in November.
Here we go. That's awesome. That's great to hear. So again, it sounds like you're a little bit diversified when it comes to commercial real estate. Again, mobile home parks, townhomes, and multifamily. Still own the duplexes, right?
Mm-hmm.
Still have those. So a little bit diversified. So what's currently happening, like in your pipeline? Are you currently actively looking for deals? And if you're looking for those deals, what type of deals are you looking for?
Yeah. So one of the things that we have done, which has allowed us to diversify even more, is we're a little more focused on the capital raising side. Now, so we're more on the money side, fundraising and having our partners, and we're not as much on operations. And so that has allowed us to have diversity. So we have the mobile home park, we have multifamily, we have an RV park as well, and a single family portfolio. And now we also have industrial. So we've been moving more into the industrial space since 2018. So we started the end of 2018. I was getting a little wary of the multifamily space because there are so many buyers trying to buy in multifamily, and it became a seller's market. And I realized that, especially when we went to sell our Albuquerque properties. They were, we had this one, it's a C minus minus, area and property. We did our best to fix it up, but that was a really tough one. That one had like fires and shootings and like just not good.
Ouch.
A
Yeah.
lot of drama with that one. We sold it at a 4 cap, a 4 cap, like a C minus, like D
Yeah.
plus maybe, like multifamily in Albuquerque,
Yeah.
New
People
Mexico.
people just overpaying is crazy. They just
People
want to have
over,
something. Yeah.
it's crazy. So I was like
Well, it was good
going,
for
okay,
you.
it's good to sell, but I don't want to be buying in this
Yeah.
craziness. I was like, I'm competing against this. All right, people that are willing to pay so much for so little. So I went, okay, let me look at what other asset classes are out there. And that's not to say that we're totally closed off to multifamily. We did get 900 units last year. But they were off market. The deals made sense. So that it really, really has to make sense, numbers wise. But I've liked industrial because um, this is not as crazy. There's definitely
Mhm.
not the feeding frenzy, and it's pretty stable. So it's one of the asset classes performed the best during COVID. There's
Mhm.
demand. They're triple net leases. For your audience who doesn't know what a triple net lease is, their tenant pays not only they pay rent, they pay property taxes, they pay insurance, they pay all the maintenance. Right? That's like, um, and they're very long term. They're very solid tenants. So I like that, and it's similar returns to multifamily for our investors, but without all the moving parts, with much less like craziness. So that's where we've moved more towards this year.
Mm. So kind of, so let's say if you're going to come across some deal, let's say from a passive investing standpoint, like is that going to be industrial, or you still would be willing to invest in multifamily or townhomes or mobile home parks? And if so, like how do you differentiate if it's a good or bad deal for yourself personally? Kind of maybe because I think for the people who are looking to invest in those deals passively as well, I think kind of understanding what makes a good deal good or bad deal bad.
Right. So I think there are three things that I look at when I'm focusing on what to invest in, and especially when I'm bringing my investors along with me. So I have a certain risk tolerance for myself. I have a very low risk tolerance for my investors' money. So there are things that I look at. I mean, the first thing is team, right? So our partners, the ones that we will partner with, they're amazing, great long track record, great history. So the partners are really important. That's the first thing, the team. Um, After that, with regards to asset class, we'll look at certain asset classes, and it's the market. So we look at the market, what's happening in that particular market. Now, with the types of industrial deals that we're doing, the market is not quite as important as um, the company. So we've been focusing on this type of deal called a sale leaseback, and basically there is a company that owns a facility, but they want to sell that facility. They still want to use the facility, but usually they want to sell it because they want to get access to the equity in the facility. Sometimes they want to sell because of their tax benefits to selling. Other times because they just don't want to run the real estate. They just want to run the business. There are a variety of reasons, but they want to sell the property but still use the property. So they sell it and then they lease it right back. They go from being the owner to the tenant with the triple net leases. So they pay the rent, they pay the property taxes, insurance, all the maintenance. If there's a issue with the roof, they fix the roof. Issue with the foundation, they fix the foundation. This is these are the leases. So the more important part of these, we do look at the market and we're looking at the vacancy rates and things like that. But the more important part of those types of deals is the company. So
Mm.
how strong is the company? That's where most of the due diligence is, because it's a 20-year lease and you do not want to lose these tenants.
Yeah.
It's a pain in the butt to replace one. To replace one, it's not every every day you're going to find somebody who needs 300,000 square feet of industrial space. So that you need a very, very strong company, very well capitalized, and we have ways to mitigate risk. But that's where that's in those deals. That's the main thing that we're looking at is the strength of the company. So that, but those are good deals, and they're,
Got it. So
yeah.
I do imagine that you're kind of looking for deals, and let's say if it's industrial kind of, warehouse or, any of these industrial properties, it's going to be kind of southeast, southwest, as far as I understand. So when
No,
it go, no?
no, we've gotten this year. We got one in New York. We got one in California. We got one
Okay.
in Arizona. We're
So how
about
do
to
you,
get ones in
so
Michigan. Did you know?
and how do you look at the markets? I mean, is that a big factor when it comes into play,
It
when making those investment decisions, when you like,
for
do you do the like marketing kind of analysis and just see the trends and what's happening with the demographics, and how much do you put attention to that?
So for the sale leasebacks, so I'm not talking about
Yeah,
multifamily, the market's everything,
yeah,
right?
it's
Like,
everything.
that's
Yeah.
very important. So it's sale leasebacks. Like I said, it's the company is the more
Hmm.
important thing. And so, but we do look at the market, and but it's more about the company. So generally these are companies, they've been around a long time. So the companies the ones we've done, the companies have, most of them have been at least like 15-year-old companies, 20-year-old companies, 30-year-old. They're a long track record.
Hmm.
So it's more about the company, because you're going to have it's a single tenant lease and it's a 20-year lease. So you're not necessarily worried about like other tenants coming in.
Yeah.
But we are in places where there's very low. We do look at the vacancy rate for industrial in that market,
Hmm.
and we want very low vacancy rate. So if we did, God forbid, lose that tenant, then we could put somebody else in there. And then where with industrial, it's important. It's just you need some place that's near transportation.
Hmm.
But it's not with the single with
Yeah.
these
You don't go
sale
crazy.
leasebacks.
Yeah.
The market is not quite as important
Got it.
as the actual tenant.
Yeah, yeah. Okay, so when it comes to like during these times, if you're still watching this episode and it's been recorded 21st of October, so
Mm,
today is still during the COVID. So I mean, when it
yeah.
comes to the I do understand these are long leases, but again, for the people who have no clue, like, and you mentioned these people are going to be there in place for quite a long time. So maybe you can talk about how long are the leases for these companies, and during times like these, is there any problems when it comes to collecting, those payments, and how do you go about, doing the like solving these problems?
Yeah, so it depends on the companies. The ones that we've gotten this year, they are thriving now. So what's nice is that we're seeing their performance in the middle of the pandemic, and they're essential companies. They're doing well. Um, it is possible. There was one that I decided I didn't want to do, even though the company was doing okay, but it was a restaurant brewery, and I thought, I don't feel comfortable doing a restaurant one in this market, right, in this economy. So you have to see like what's going to what will survive. But we so that's the main thing. If you do have an issue with the tenant, so as part of our leases, we get quarterly financials. So you know, nobody could have foreseen a global pandemic like this, right? So that would have been hard to foresee, and you'd seen like somebody's financials at the end of like the fourth quarter 2019, and then that very different world that we're in right now. But we do try to get the financials so we can, in a normal economy, see where they're headed. We also have other ways of helping to mitigate risk. A lot of the companies will personally guarantee, the owners will personally guarantee the leases. We look at their capitalization, make sure they have a lot of money in the bank, and that so they could easily afford the lease. the leases are also slightly below market. So if we did lose that tenant, then we could put somebody in there and still cash flow. We also buy them at below market, slightly below market, so that if we have to sell, then we have built-in equity. So there's ways to mitigate, but it is tough if you have a single tenant and something happens with that tenant, or that tenant is struggling. So that is why we do so much diligence to make sure that they're
Yeah.
going to be a strong tenant,
Yeah, because you know all these
regardless.
multifamily people right now, they just probably just shaking their heads, is like, oh my God, one tenant, you know?
I
It's
know,
for
and
them, it's
when
awful.
I first heard about it, I was like, "That's crazy! One tenant, that's so much risk."
Yeah.
But when you there, but it's not. It's like such a strong tenant. Like we
Hmm.
have this one, and we have one deal that we're doing now, or we just did, and they're, it's a 30-year company. They manufacture skincare and hair care product. They sort of they put them together for different brands, but they have a bunch of different brands. There's no one company that's their big, that all, like it represents 80% of their business, or even 50% of their business. Nobody represents more than 10% of their business. And so they have a lot of diversification, and it's for like skin and hair care, which is people will
Hmm.
still have skin regardless. People still care about their hair. In fact, that particular industry is like booming during the
Yeah,
pandemic.
yeah,
I didn't,
yeah. Oh,
but so
definitely.
yeah, so you have to really look at the company, and to see like what's the strength of that
Hmm.
particular company, and then and that's what you're really investing in. It's a real estate play, but like I said, the big due diligence piece is on that particular company.
Hmm.
And then, you have one huge like company with a track record
Yeah.
that has a lot of money in the bank. That's actually a much less risk than, even if you have like a 200,
Yeah.
300 tenants, but who are sort of with precarious job situations.
Hmm.
You lose enough vacancy, and then you really have a challenge.
Yeah, that is so true. And I love the fact, because again, these are triple net lease, so they paying you the rent and covering their own kind of expenses when it comes to
Yeah,
maintenance, and they paying the insurance. So, and I'm pretty sure you don't have a property management to look after these people, which is like multifamily. You have to run kind of
yeah,
day-to-day operations. And one thing that you have
exactly.
to pay attention, as you said, is just vetting the operator who's going to be, you know, like renting the facilities, but that's pretty much it, and maybe the location. But I'm pretty sure, like, if they're looking to lease the property, they already did their own personal due diligence to make sure that the market is
Just
is in good shape,
yeah,
for them
and
personally.
these are facilities that are like exactly suited for this company.
Yeah.
They do not leave the facility unless something very like unless they're going
Yeah.
out of business. So it would be pretty dramatic for them to want to leave. They don't want to leave that facility ever. So they might grow, and usually they're selling so they can buy more equipment and fix up the inside. So they're very invested and not going anywhere. And in almost 2 decades, our partners have been doing this for almost 20 years, and in 20 years, well, first of all, none have lost money, but there's only one of, dozens that has not even hit projections. And in that one, they projected 16 to 20% returns, and they only made 15%. Um, so it's just there. I know it can sound scary, like, only one tenant, but it's like, but who's the tenant?
Yeah, yeah,
That's
exactly.
the,
So,
yeah.
can we talk about, again, like, because it's different, and it sounds like it's more kind of, it's more stable, as far as I'm concerned. It sounds like it's more, a little bit more stable than some other, commercial investment vehicles out there.
Hmm.
But can you talk about the deals? How the deals are structured? Is it kind of traditional syndication, or is it different? When it comes to passive investing in those type of deals.
Yep, traditional syndication and fairly similar returns to multifamily. So usually it's like 8 to 10% cash on cash returns, and
There's
cumulative annualized returns in the high teens,
and
maybe low 20s.
there's no equity multiple. That's the difference.
No, I mean, usually it's about 2x in 5 years.
Is that okay?
Yeah.
So what is the exit strategy on those type of deals? I mean, how do you?
So we exit by selling to an institutional buyer
Oh,
in
okay.
like 3 to 5 years. And so these institutional buyers love these, industrial deals with a stable tenant that has 3 to 5 years of steady payment history with 15 to 17 years left on a lease. So they don't do the sale leasebacks, but they'll buy
Mm.
these deals afterwards all day, every day. So
Nice. Okay. Okay.
yeah.
That's good to hear. So okay. So I mean, talking about what you do, and you help women in particular again to create those income streams. So maybe we can talk about, because I was going through the website and I seen there's some training and programs and events, and there's some free training that of course you can find real estate investorgoddess.com. Of course, that links is going to be down below. So maybe you can talk about, again, maybe first if we can cover the podcast, what type of approach are you using there, and what type of topics should people expect?
Sure. So on our Real Estate Investor Goddesses podcast, I interview successful, badass women real estate investors. I
Love it.
think it was just when I first started, I saw so few women in this space, and I would go to events and there'd be like 90+% of the room would be men. There were no men. And it actually came as this divine download, my mission to help 1 million women create financial freedom.
Wow.
And
Yeah.
and as part of that, I wanted to inspire women and have them see that it is possible for them to be successful. So I interview women all who are doing all different types of real estate, of all different ages, all different backgrounds, from like the single mother who was homeless, who's now, like a mogul, to the one who inherited it but has grown her, has, and multiplied what she grew, and to the grandmother who got into investing, to the 18-year-old who started, and everything in between. So just so that people can go, oh my gosh, if she could do it, I could too. So that's what
Mm,
the podcast is about.
got
With
it.
the with our training programs, um, I we teach foundational principles for real estate investing, and how to do this as a woman, because women, we are not just smaller, less hairy men. We actually are different, not just chromosomally, but in how we approach money and how we approach investing, and how we best learn. And so we focus on how do you play this game as a woman. But real estate investing is not one size fits all. So it's not a cookie cutter. Everyone does the same thing. Like everyone's going to wholesale, or everyone's going to flip a house, or everyone's going to buy a single family rental that way. So we take people through a process to figure out what is the right path for them. And so there
Mm.
are different women doing different things in our training programs, but within the context of sisterhood, and in the feminine way.
Beautiful, beautiful. And again, I'm looking at the program on the website, and it's one of the things that I'm seeing thrive through COVID-19 bundle package. And I see there's some familiar faces that I came across personally. So I mean, some really heavy hitters you have there, available for the virtual summit, recordings and all these trainings. So that is very cool. Again, like, because you personally, I don't know, have you came across personally, because coming back to the point that you're a little bit diversified, for the people who are still thinking about what should I choose from, like if it's real estate, stock market, or should I go and start a business, like why real estate in particular that people should be involved with, I mean, particularly during times like these.
Yeah. So, I mean, I personally love real estate because it's investing and it's a business. So you're on both sides of that quadrant,
I
right?
like that.
You're on the, on the right side of the cash flow quadrant. And there are, there's the passive income streams. It helps you with long-term income. It helps you leave a legacy. For millennia, real estate is the way that wealth has been created, built, and passed down. And that has not changed. And it's also you get incredible tax benefits by being a real estate investor that are hard to find in other areas. So for all of those reasons, I'm a big proponent of having real estate be a significant portion of portfolio, though I believe in diversification. So I think you don't want all of your eggs in one basket. I'm very happy these days that I have a variety of different, I'm in different markets, I'm in different asset classes, because some, like our C class is struggling more than, a lot of those tenants aren't paying rent right now. And so it helps that we have all of these other income streams to help, where we're fine and things are being propped up. So, but with regards to how should somebody start, again, like I said, real estate is not one size fits all. So there are different ways to get into that game, and it depends on um, what your resources are starting off. It depends on what your time, your bill, how much time you can put into it. It depends on, the other resources that you have to bear. um, I wrote a book that's available as a free download on my site, Investing in Real Estate from $1 to $1 million, investing strategies for every budget and every goddess. Um, Even guys can get a lot out of it, but I share 12 different strategies, and some require little to no money, some require or little to no time, and some require no dealing with tenants. You don't have to deal with the tenants, toilets, termites. You can invest without having to deal with that. Because I know a lot of people are like, I like the idea of real estate. I do not like the idea of getting a call at 3 a.m. from a tenant about a toilet, right? Or having to evict somebody or doing any of that stuff. They don't want to do that. So there are ways that you can invest without having to do that. So I recommend that you go to reigoddesses.com and just get a free copy of that book. Just get a sense of what might be a best fit for you for real
Here you
estate
go.
investing.
Here you go. And there's 12 strategies there that will give you kind of guidance and tips and tools, on and put you on the path how you can start your own personal real estate business or get involved with it. So,
Yeah.
I mean, like how parts, again, looking at the website and I see you have a lot of it when it comes to the social media and you're speaking, on podcasts just like this one. And I really appreciate you being today on the show. And I see there is a few like Facebook, Twitter, Instagram, YouTube. So, like, how important for you is social media and marketing part of the real estate business?
Well, it really helps me, in creating a brand and building a network. Like right now, I do not have to go after investors because people come to me. And as I'm going and I have this mission to help 1 million women, it's a lot of women. So that I have to build something that is very scalable in order to be able to do that and really be able to touch and so that I can touch more people. So I do. So that's why I've worked to build, with the podcast and with social media to get out there, so I can reach more people and let them know what's possible for them. And but just in general for people who are out there who also, if you're interested in syndicating and you want to build a real estate business, then you need to bring people in. If you can bring people in as opposed to having to go out and dial for dollars, it makes it a lot easier when you've created a platform and people find you versus you having to find them. Now I have I guess, fortunate problem. It still is kind of a problem that when we have opportunities, they feel so fast, almost too fast. And so we have to say no to a lot of people a lot of the time because things will fill in like a couple hours now. But that was a problem I never thought. I'm so happy to have now, but I never thought I'd have that problem. Um, but I remember having a couple friends and they'd be like, I don't know what to do because we feel like things can fill up really
Yeah,
quickly.
yeah.
Um, but so now, we need to find more deals to help serve and get more people, more of our passive investors in the game. But because I've put things out there and then people come in and go, oh, and they raise their hand, say, I'm interested in investing with you or, learning with you, then I don't have to go out. I'm putting in a lot less effort. I'm sort of like
Got it.
then, that way.
Got it. So I kind of, when you talked about kind of being on a right side of the quadrant, so talking about Robert Kiyosaki, when he mentioned, there's two problems, not having money and having too much money. And he said both of these things are problems. So kind of, similar to what
Yeah.
you're currently having. So how do you go about, I mean, maybe you can share, and I'm sure part of that again is networking, maybe personally, that's prior COVID, and maybe doing that a lot right now through, again, social media, a lot of Zoom calls, I'm sure,
hmm
but there's marketing involved. But how do you go from, as you said, like two people where you don't know where you're gonna capital from, where you're gonna raise it from, where you go to oversubscribed on the deals?
Yeah, so it really has been building relationships, but it's easier to build, like I said, build relationships en masse than it is one-on-one. So one-on-one works and is wonderful, and that, at this point, I'm still like, when people fill out investor club form on my website, they talk to me, and we have a one-on-one conversation, and I get to know all of my investors. But I I can't, in order to reach 1 million women, I can't do that one on one. It has to be like more to scale. So
Yeah.
that's why that's how I think that's what works best. But
Got it.
it's not for everybody. Not everybody wants to go to that level or needs
Mhm.
to,
Yeah.
desires to. So then the just the individual, like more like, one-on-one relationship building is what works best for them.
Oh, definitely. Because if somebody is looking to get invested, and like if ladies are watching this episode and you want to get invested with you personally, and they want to get to that personal level, and they would like to schedule a call with you and jump on a call and kind of discuss, because if somebody will be investing, if it's a traditional syndication, let's say 50,000, they,
Mhm.
they, they want to know if they can trust the person, and that's kind of the
Of
main
course.
issue, right? Is the
Yeah.
trust. Can you
Yeah.
get that? Can you build that? And if people will trust you, people will invest with you. So, and that's
Yeah.
happening for you.
So there's a know, like, and trust factor.
Yes.
So, as part of that, you need to be known.
Oh yeah.
And so first they need to know you, know that you exist, and that's what the social media did. Then they can figure out they like you, and then they can follow up, and then it's trusting you, and that requires being trustworthy. So
Exactly.
hopefully I try to be worthy of the trust placed in me.
Awesome, awesome. Definitely. One thing that I wanted to ask you, kind of the last question, because I love the impact that you want to leave. Again, 1 million ladies, and hopefully this episode will help you get closer to that goal. So I definitely encourage everybody who's watching, share it with a friend of yours. If she's a lady, make sure to pass it along. Again, this episode, and let her know about Monique and how she can help her to get involved with real estate business. It's either through active or passive investing. But yeah, make sure to do that. But one thing that I wanted to ask you, it's part of the 1 million, women, helping them to become financial free. Like, what is the overall? If we're gonna go to the core, like, what is the legacy that you want to leave behind you?
Yeah, that's such a great question. So for first, I'll define what I mean by financial freedom. For me, that means that you have enough passive income streams so that um, the passive income equals or exceeds your expenses. And at that point, you work because you want to, not because you have to. And I was really excited because last week I had a conversation. So at the end of the year, so the women who joined my program for a year, at the end of the year, I have a results call. So I had a call with one of my goddesses, and she was saying she's pregnant and she's going to go on maternity leave in November. And she was sharing that she started in real estate investing in this program about a year ago, and she's going to go off on maternity leave. She does not have to back to work. She's created enough passive income streams so that she's replaced her working income, and she's free. And that, like yes. So it's like, that is what I'm about. And the reason that I am so passionate about that is because I believe that, especially with women, when but I think in general, when we have more than enough time and money, right? So gives them more time, more money, then we give back. We give back to our families, we give back to our communities, we give back to the world. We start to share the gifts that we were born to give, and the world needs us to be, now more than ever, to be able to do that. And without the worries of like keeping a roof over your head and having food on the table and having to trade your time for money, then you get freed up to do what you were born to do. You get freed up to share the gifts that you have to share. So my legacy in financially empowering women, and women, there's been a lot of studies, like when you, especially like you just you get women economically empowered, you you will affect at least 3 generations, and the whole community gets changed. They've done all these things with like microloans where they start giving it to the women, and just it's completely transformational for communities. So for me, helping women is my shortcut for helping the world.
And that is beautiful. That's a great mission. That's a great legacy to have.
Yeah.
Yeah, that's beautiful. Awesome. So, guys and girls, in particular, girls, I think this is a great episode for you. So, as I said, make sure you get in contact with Monick. And again, there's all these links, website. I don't know what will be kind of the best way for them to get in contact with you. Is there like Instagram or Facebook? What would you prefer?
Yeah, so you can go to reigoddesses.com and connect, find out all this information, or we're at REI Goddesses on all the socials.
Here we go. Here we go. So again, Monick, I really appreciate you joining me today on this episode. I love the fact where you started, the journey that you're going through, and you're helping a lot of ladies to achieve the financial freedom. So again, I hope we added some value to you and your business and to your goal to reach that number. And again, guys and girls, make sure to share this episode with a friend of yours. And again, I appreciate you being on the show. And as always, I'll see you next time. Thanks for watching.
Thanks for having me, Martina.